US investors returned from the 4th of July celebrations to find out that the US dollar is still trading near a 40-year high against the Japanese yen, despite the disappointing non-farm payrolls report, while also holding firm against the euro. On the other hand, Wall Street started the month on a weak note. It's sending some discouraging technical signals ahead of the next earnings season next week, increasing speculation about whether this is just a pause in the record rally or the start of a deeper correction. So as investors wait for the FOMC meeting minutes and comments from key central banks, let's have a look at what the technical signals suggest about dollar yen, euro dollar, and the US100 index. Starting first with dollar yen, we can clearly see that the pair has almost recouped its losses from the post-NFP session. Despite the weak job creation in the US, the US dollar is still trading firm against the yen. Obviously, Japanese officials have yet to intervene to save the yen. It looks like reports are now suggesting that Japanese officials are changing strategy. Perhaps they want to make trading bets against the yen's weakness more expensive instead of sending strong intervention, verbal warnings. In any case, Fed and Bank of Japan rate differentials keep support under the yen, and the week ahead could bring more volatility as the FOMC meeting minutes are on the agenda this Wednesday. Investors will be looking for any clues about whether Kevin Warsh's hawkish approach is shared within the board. And if that proves to be the case and rate hike expectations strengthen this week, dollar yen may approach the 163.40 region before meeting the 161.8% Fibonacci extension of April's downfall at 164.25. But policymakers will be also on the wires on Thursday after the FOMC meeting minutes, so perhaps we may get an update about the Fed's thinking ahead of Kevin Warsh's semi-annual hearing before Congress next week. Now, what could bring selling pressure in this market? Well, perhaps a break below the 160.45, 161 could play a key role in pressuring the price towards the 50-day moving average at 159.60. Below that, all the attention will turn to the 158.50 barrier. And now let's have a look at euro dollar, which keeps struggling to gain ground despite last week's recovery attempt. The price remained below the 20-day moving average. It faced rejection just around the 1.1470 level, and that creates some concerns about whether this is just a short break in this downward pattern. Well, reports during the weekend suggested that ECB President Christine Lagarde may leave her position earlier as she tries to set a path towards French politics. So that, of course, we can see the price trading a bit weaker after those reports, but obviously ECB policymakers could update us about the ECB's policy approach later this week. ECB chief economist Philip Lane will be also on the wires during the week, and Eurozone's finance ministers also meet for their monthly talks. So perhaps ECB commentary could be a market-moving event for euro dollar later this week, along with FOMC meeting minutes. And what we are waiting to, what investors would like to know is whether the ECB could shift to a more hawkish policy approach after Christine Lagarde said that the recent rate hike wasn't an insurance, but it was a robust decision. So any hawkish commentary from ECB could support this market, but obviously the dollar strength could also play a key role. We can see the price struggling to hold above the 1.1420 at the moment. This is a key support line connecting the lows from July 2025 and to March 2026. So failure to hold here could press the price towards the 38.2% Fibonacci of 1.1355, which acted as a key support at the end of June. If that fails to hold, perhaps this downtrend could stretch towards the 1.1275 level and then probably aim for the 1.12 territory. Well, looking at the technical signals, we can see that the price, despite some improvement in the RSI and the stochastic oscillator, we can also see the MACD showing some improvement above its red signal line. Obviously the price should stage a notable rally beyond 1.1455 and then also break the barriers within 1.15 and 1.5030 region, as well as the obstacles seen between 1.1580 and the 23.6% Fibonacci of 1.1630 in order to shift the outlook back into bullish territory. So in the meantime, there's a bear structure well intact with the price just fluctuating within this broad bearish channel. And now having a quick look at the US100 index. Well, this is an interesting case, an interesting market to watch, as we can see the price fluctuating within a neutral triangle. Well, I can also see a bearish head and shoulders pattern created within this triangle, so which of course still needs confirmation below the 29,250 and more importantly beneath the 23.6% Fibonacci retracement level of this uplift at 28,800. So only a break below this territory could send bearish signals, could activate fresh selling towards the 28,200 level where the price pivoted in mid-June. Then below that, the 27,700 region, which includes the 38.2% Fibonacci level, could also act as support against the selling pressures. So far, AI optimism has been supporting the market. We saw the price holding very well above the 50-day moving average, which keeps questioning this bearish pattern. Perhaps AI will remain a key market driver. We had, reports suggest that NVIDIA's next AI Gen model will be delayed until 2028. OpenAI looks to be in talks for giving a 5% stake to the US government in order to avoid political obstacles, as well as diversify its risk, probably as AI competition is increasing and cheap AI stocks such as Micron are gaining more ground. So it's going to be a competitive environment on the AI front, and investors, of course, seek for fast solutions. If they don't get such signals, then that is a warning signal about the rally in US indices. But obviously, Fed's signals about a tighter monetary policy could also play a key role. Perhaps this is one of the key catalysts that the US100 index started the month on a weak note. Nevertheless, if the 50-day moving average manages to hold a key floor under the price, then probably the bulls may attempt to reach the upper band of this triangle near 30,520 or even approach the 31,000 mark for the first time in history. Even higher, steeper increase could approach the 261.8% Fibonacci extension of the previous downfall that started early in June and completed in March. So it's going to be an interesting week in terms of central bank signals, Fed commentary, and obviously today's ISM business PMI figures could also cause some volatility in the US dollar. So keep a close eye on the week ahead events, and Obviously, you can always visit our XM website for more fundamental as well as technical updates. In the meantime, it's a goodbye from me, and we'll meet next on Thursday for our next technical update. So thank you for watching, and see you next time. Bye bye for now.